In this video, we will explore about the qualities of a good research report. Writing a research report is one of the most critical skills for an analyst because it is the primary way you communicate your hard work to the world. It is not just about crunching numbers, it's about structure and discipline. To understand how a report is built, look at the process funnel on your screen. An analyst starts with a massive amount of financial information on the left. This includes annual reports and data sheets. This raw data goes through a creative process in the middle, which is your analysis and thinking. What comes out on the right side are understandable views. A good report does three things. It presents an investment idea, provides a market perspective, and offers a detailed company analysis. Remember, thousands of analysts have access to the same information. To stand out, you need the key differentiators shown at the bottom, which are clarity of idea, simplicity of delivery, and clearly presented arguments. Now, let us look at the workflow for writing a good research report. It is a creative process that requires a structured approach across three stages. First is planning. Here, you must approach each section individually, assign deadlines, and maintain strict discipline to avoid delays. Next is drafting. This is where you use templates and start filling in the content. You fill in the fact-based sections first and then develop your view-based sections using data visualization to make it clear. Finally, we have editing. Never skip this. You must recheck all financial figures, run spell checks, and refine the language for absolute clarity. When drafting, it is helpful to divide your report into two distinct categories: fact-based sections versus view-based sections. On the left, you have fact-based sections. These include the peer group analysis, shareholding pattern, and company fundamentals. The source for this is standard reports, and the nature of this work is essentially data entry. On the right, you have view-based sections. This is where your value comes in. It covers the company business, key strengths, key concerns, and industry overview. The source here is management communication, and the nature of the work is creative and analytical. It is also important to know what does not count as a research report. Certain communications are excluded from this definition. If you are just commenting on general trends in the securities markets or discussing broad-based indices like the Nifty 50, that is not a research report. Other exclusions include commentaries on political conditions, periodic reports sent to mutual fund unit holders, internal communications not meant for clients, and statistical summaries. Also, offer documents and prospectuses defined by SEBI regulations do not fall under this category. So, what makes a report succeed or fail? We have analyzed why reports often fail to make an impact. As you can see on the left, reports fail when they contain unnecessary details, use long and confusing sentences, or lack a proper structure. Inconsistent views and complex language also turn readers off. On the right, you see the success factors. It all comes down to just two things, which are clarity of idea and simplicity of delivery. Remember, thousands of reports are generated every season. Only the simple and clear ones get the attention they deserve. Now, let us decode the jargon of rating conventions. When analysts give a recommendation, they usually follow a standard scale based on expected returns. A sell rating typically means we expect negative returns of more than 10%. A hold rating implies the stock will likely stay flat, moving between minus 10% and plus 10%. A buy rating suggests we expect positive returns greater than 10%. Below that, you see relative ratings. Overweight means we expect the stock to perform better than the market. Equal weight means it will perform in line with the market, and underweight means we expect relatively poor performance compared to the market. Moving on to a crucial tool for your success, the checklist based approach. This is inspired by Dr. Atul Gawande and his book, The Checklist Manifesto. In finance, we suffer from information overload and ignorance. To combat this, we need discipline and order. We must distinguish between two types of errors. Errors of ignorance are mistakes made because we simply did not know enough. However, errors of ineptitude are worse. These are mistakes made because we did not use what we knew correctly. Checklists are the best way to prevent these errors of ineptitude and ensure consistency. Let us look at the 4 major advantages of using this checklist approach. First, it helps you avoid lazy mistakes by preventing you from taking shortcuts. Second, it ensures discipline by forcing you to execute your intent consistently every time. Third, it brings objectivity, ensuring your decisions are based on facts rather than emotions. And fourth, it creates a decision trail. This is a record you can look back on to correct your process in the future. Now, let us apply this checklist to qualitative parameters specifically for business and industry. You need to ask yourself a series of hard questions. Do I truly understand the business? What is the revenue model? And how does it actually make money? Is the output a necessity or a choice for the customer? You should also look at scalability to see if the business can grow. Ask about the moat, which is the competitive advantage. Do they have pricing power over their output and inputs? Finally, evaluate the competition and the downside risks to see what could go wrong. The next part of our qualitative checklist focuses on management and SWOT analysis. For management, you must assess the quality and integrity of the people running the show. Look at the promoter stake and whether they are pledging their shares. Check if insiders are buying or selling. Then perform a SWOT analysis. Identify the strengths, which are internal advantages. Identify weaknesses and ask how they are being handled. Look for opportunities in the external market. And finally, identify threats and checks what mitigation strategies are in place. Now we move to the quantitative parameters. This is where we look at the health of the numbers. First, look at revenue for consistent growth. For profitability, we want to see a net profit margin greater than 10% and continuous growth in earnings per share. For leverage, which is debt, we want a debt to equity ratio of less than 1 and an interest coverage ratio greater than 3. For returns, we look for a return on equity greater than 15%. We also need to see positive operating and free cash flows. Finally, always check the audit reports for any qualifications or red flags in the notes. Finally, we arrive at the valuation parameters to make our final decision. The core question here is, what is the intrinsic value? You must weigh the price on one side against the intrinsic value on the other. This helps you determine the margin of safety. Is there a discount available? You need to ask if the stock is cheap relative to its peers and the market using ratios like PE or price to book value. We also look for mispricing to see if there is a likelihood of correction. Your final decision should be based on buying for the quality of assets, earnings, and cash flows.